Alright, what's up y'all? This is Uncle P, and here's another video showing you guys some very easy stuff. Just like I told you, this is one I was still holding, the NZD Swiss, but then I added in the CAD Swiss after news had passed, and you can see I had accomplished, and it's still running. The market is slow right now, but I was able to hit 24 and a half pips on this trade right here, simple half and half. Here's the arrow. This is CAD Swiss, and so I'm just showing you guys some very simple stuff. This one I should have hung on to longer. As you can see here, if I would have held it longer, remember I've recorded this video for you guys. This would have netted about 115 as of today, but I didn't hold it long enough. I should have, but that was okay. I'm still holding this one, so this one will probably pretty much do the same thing, and hopefully this one will follow through and do the same and keep pushing up higher and higher. But as you can see, they all have one thing in common: all the candles are small. And when it came in with the alert, this does come with a scanner, by the way. If you want the scanner, it comes with it. It's no extra. But right here you can see this was an easy trade. Now it's bouncing around, so you can see that it's actually still in motion at the time that I'm recording this. And so this one here, it's just a lazy, kind of like a lazy river kind of trade. So it's just slow and steady wins the race. But I want you guys to just imagine if you had were trading a prop firm account and you had to pick one particular trade, and you wanted almost, because again, news can come out, anything can happen, almost guaranteed money, and you only could pick one trade. Which one would you choose? That's the question. So this is why coming to my class on Wednesdays is very important, and paying attention to what I'm teaching you guys about these small candles are king. It's slower, but it's more dependable. It's slower, but it's more fruitful. And this is actually what the banks and institutions would prefer to trade, because they know they can put tons and tons of money on these particular trades without having to be concerned about it spiking against them and all these different things. The difference between the retail trader and the institutional trader is the retail trader has no patience. The institutions who make millions of dollars, and I just posted this in my group, the institutions, anytime you look at financial reports from an institution, you'll always see that they will say, even on my FX book, it'll say MOM. MOM stands for month after month. So they compare results from one month to the next month. Okay. The retail trader compares results one trade at a time. Okay, so if they have one good trade, then one bad trade, then they just switch everything up and start all over again. As opposed to the institutions, they will judge success based off of how long can this do XYZ. In addition to that, the other thought process is when institutional traders look at trades, which is why they typically be swing traders, never scalpers. Okay, tell me the last time you ever, let me give you a question. Do you ever think that banks are scalpers in the market? Okay. Do you think that banks are more swing traders and long-term traders or scalpers? I'm just asking a question. So then, as you can see they prefer these types of trades right here, because these are slow and steady. So for their investors, they're making 10, 20, 30% on the account without actually lifting an additional finger to take extra trades. So they like to take these types of trades because it's very rhythmic, very slow, but they can judge at the end of the month, hey, here's what we were able to do. It may take a month for it to get to this point. It may take a week for it to get to this point. It may not happen as a day trade. It may not happen as a overnight 24-hour trade. But if at the end of the week, at the end of 2 weeks, they have the ability to say, hey, I was able to make profitability off of this trade, blah, 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 blah. Just imagine you had 100 standards on this trade right here, and you only had 27 pips to show for it at the end of the month. Okay, so let's just see. So 100 and times 10. $10 a pip, or $100 a pip. Okay, let's say $100 per pip. Okay, and I think I'm doing my math wrong. Times 27 pips. Okay, yeah, I'm doing that wrong. Hold on. let me see, $10 per pip is a standard, so you have 100 of those. Okay, so we'll do 100 times 10, $10 a pip. Okay, that's 1,000 times 27 pips. Okay, so let's just say you did that. Okay, I think my math is still wrong, but let's just say this is what you did, and this is all you did. You took one trade, and this is what the results were at the end of the month. That ain't bad, is it? Okay, so anyway, y'all get the point. So I'll see you guys in the Wednesday's classes. Otherwise, I will see you in the next video. And I think, let's see, let me check this one again. Yep, that's 25. So let's do math. Let's say you had two of those. So you had, let me pull up this calculator. Let's do this together. So you had 25 plus 27. That's 52 times 1,003. That equals, and that's for your month. $100 a pip. Something like that. Either way it goes. Y'all get the point. Okay? I'll see you in the next one.